Now, the question becomes, as you saw, there has been a continuous downgrade of earnings in the last 2 to 3 quarters. And I'm telling you that the September quarter, there could be one last downgrade. Now, end of the day, a lot of this is the reason why India has relatively underperformed and FII flows have not yet come in, like what many people should anticipate or would anticipate. So, what can cause this to change? Now, if you look at it, unlike China, which derives roughly around 28% of its GDP and PAT from manufacturing, for us, manufacturing is a lot lower today as we speak. As we speak, roughly around two-thirds of our GDP and market cap is coming from the consumption sector. Not only this, our net profit of effectively corporate India, of roughly around the top 500 companies by market cap in the listed universe, again comes from consumption. So, end of the day, if you think about what should be done to revive growth, you need this consumption to go up. So, if you think about what the government has been doing in the last 9 months and superimpose this with where your economy is, certain aspects will align to basically say A, interest rates have been cut, B, tax benefit has been given, GST has been cut. All of this is effectively to revive this two-thirds of the economy. So there is a certain belief right now that this segment of the economy can give you a kickstart over the next 2 to 3 quarters to drive growth. And the government is focused in terms of this. And one of the primary reasons that we have not seen our cost of capital at this level in the last 20 years is because it's an intentional effort by the government to keep the cost of capital low such that consumption can increase. And within this macro, Indian macro globally is extremely accommodative in order to drive growth. So if you look at the RBI's projections over the last few meetings, each one of those projections have been in line with saying that the inflation environment is relatively low. Our cost of capital has been kept low, and every effort has been by the government in order to actually bring lending back and kickstart lending back into the economy, right? Which, if you then superimpose it into what could happen, it should result in a consumption growth. So, with this as the background, it's really important to basically say going forward, or rather 2 quarters out, it is our expectation that your leg of growth that has been lacking for the last 4 quarters should come back from the December quarter from a consumption oriented perspective. And if you look at it, our overall portfolio has been aligned with a certain element of being overweight on consumption, overweight on certain other sectors, but consumption does form a certain core part of our portfolio. Now, there are two other themes that I would want to slightly look forward to from a 3-year perspective, right? What I basically covered in the first half was walked you through the last 3 quarters around what has performance been like, both at a relative and absolute level, what has caused earnings growth to narrow, and what have the steps been from the government and where we are today versus what we should expect in the next 3 to 6 months. Now, if you take a slightly more longer dated view, I'm not saying 10 years, 15 years, I'm taking more of a 2 to 3 year view. There are two themes that I think merits attention. A, which is already in our portfolio, and B, which will increase its weights in the portfolio at the right price. One is a sector called consumer tech, right? So, for example, we are used to consumer, we are used to consumption, but consumer tech is more of a relatively newer sector. Obviously, this sector is a very difficult. Some of these companies have platform-like characteristics. What do I mean by that? You will not see too much of competition because it takes time to build and scale such businesses. Cost of acquisition generally tends to be high in the first 10 years of such businesses. But once it's done and you have a very strong ability for you to have acquired customers and provide value. Operating leverage flows into the business. So typically, these are businesses that can grow at 20 to 25% plus from a top line basis, may not translate into EBITDA in the early stages of their growth, but once they reach an inflection point, the EBITDA also begins to flow through and operating leverage comes through in a significant way, which means your 20 to 25% top line growth can translate into a 30 to 40% bottom line growth at the right point of time. The risk around these businesses also is your traditional metrics of using PE for valuation may not always be the most appropriate way to think about the business, because you cannot value it on today's earnings. You will have to take a call on 3 years out. How could the business look like, and give it a forward multiple? And that is where things could go wrong. Now, there are certain macros when such businesses tend to do well, which is periods of low interest rate. Now, if you look back in history, right, the period of 10 to 22 or 10 to 23 in the US, obviously, US, many of you are aware, US was the best performing market. And I've been talking about US could be one of the worst performing markets this decade. And that view is something I still continue to hold. But one of the reasons why US was the best performing market was the fact that its cost of capital kept coming down in the last decade. And hence, technology companies, which in FY12 used to be 9% of S&P 500, as of 24 is at 24% of S&P 500, which means roughly a 3x improvement in weights. And that means some of these companies have given you 6 to 10x returns over that decade, primarily because when cost of capital comes down, your terminal value of the business goes up. So you get rewarded for disproportionately for owning terminal value in simple DCF modeling. So you want all of these conditions to align itself for you to actually make disproportionate money. So to summarize, you need strong growth. You need operating leverage, which means the company must have turned around in terms of moving to a negative to a positive. And hopefully, you need an environment of low or lower interest rates that will help your terminal value growth. So, that is one thing that we see as the environment over the next 3 years for India. Second is chemicals. Now, this is a slightly completely different sector. Over the last 3 years, you will see, if you measure it as an industry, earnings growth has significantly dropped. It used to have a very high base, especially post COVID. It was artificially inflated. It had to get reset. But because the balance sheets of some of the companies were very strong, they continue to invest in capex. So, to put it into perspective, some of the well run companies which have strong gross margins have improved their gross block against FY21 in FY25 three times, which effectively means today their return on equity will look extremely depressed. And as this utilization improves, you will see this ROE expand in a non-linear way. And I think this, again, this theme is going to be an interesting theme to play out over the next 3 years. It may not have an immediate effect in the next quarter or so, because you need some amount of the tariff noise also to settle down, because this is more of an export oriented theme, unlike consumer tech, which is going to be more of a domestic oriented theme. So, two themes to actually keep in mind from a slightly more 3 year perspective. And there are names in our portfolio to actually reflect both the themes. You might see more of this over the subsequent few quarters. Now, what we are monitoring from here, right? So the big question that many people ask is, today, will FII flows come back? Like I said, we have seen 2 very strong years of FII outflows along with currency depreciation. Now, when you look back from FY10 to FY25, every time you have had outflows along with 2 years of currency depreciation, the subsequent year has seen FII inflows come back. Now that FDI inflows are coming back from a recycling perspective, I think over the next 2, 3 quarters, you should start seeing FII flows also come back. as some amount of capital gets recycled out of the US into geographies like Europe and Asia. Second is RBI liquidity. RBI has been fairly loose from a monetary and fiscal policy, and I expect that to continue over the subsequent quarters. Earnings revision, I think you should start seeing potential upgrades from the December to March quarter onwards. It may not, it should, I'd be very surprised if I don't think it will happen in the September quarter, but September quarter, even if it is a washout, should get brushed away because you have the festivity season numbers coming through only in the December quarter. So I think December and March 26 would be your earnings revision upgrades because most of your downgrades should have flown through post this quarter earnings. So this is broadly how we think about the macro over the next 6 months. To summarize, I think right now, from a sentiment perspective, when I talk to investors, most investors blame two things: A, lack of growth, and B, valuation. I think for markets, when growth comes back, valuation is a reflection of growth and not a standalone number. So the more important question is what is the environment for growth to come back? And I think we have the right macro for this growth to mean revert over the next 2 quarters. That should start getting aligned with FII flows coming back. DII flows are strong, and that I think should continue at a average level of where we are today. And I think interesting sectors will emerge. One last thing that I did not talk about is our view on capex. I do think capex is happening as we speak, and you will see a very different kind of capex come through over this next cycle versus what we are used to in the last 10 years.